Bismillahirrahmanirrahim. Assalamu alaikum. I am Sayyid Akif Shah, lecturer finance at Institute of Business Studies, Kohart University of Science and Technology. The title of this course is Principles of Accounting, and the course code for this subject is BS 161. This is our lecture number 17, and the topic for today's discussion is understanding the accounting cycle, and in particular the emphasis will be on making and understanding the journal, which is the first step of accounting cycle. So dear students, the outline of this lecture consists of the three basic agenda points. Number first is to make you understand the accounting cycle, its broader perspective and a diagrammatical shape. Secondly, to learn and understand about the debit and credit rules, which are the backbone and crux of the accounting subject. And to understand the debit and credit rules are very important and crucial for the subsequent accounting procedures. Third, this lecture will make you understand the journal, which is the first step of accounting cycle. Here it is a complete accounting cycles diagram, which starts with certain economic or financial transaction. Any transaction is known as an economic transaction that involves certain money transaction or certain financial aspect is covered in that particular transactions. So while buying and selling certain number of commodities, the currency unit or money is involved. Therefore, such transaction in a business organization is known as an economic transaction. So when an economic transaction has happened in the organization, that transaction needs to be recorded in the books of accounts. So the first step in the accounting cycle start with journalizing those transactions, which we will see shortly with the help of debit and credit rules, that how to journalize such economic transaction in T accounts and then subsequently in a particular journal format. So after journalizing the transaction, by journalizing we mean that this is a chronological record of the accounting transactions, economic transactions, It is a chronological record as highlighted with the name of journal or journalizing the transaction. By journalizing we mean that we have to record the day-to-day operation in this book of account, which is known as journal. After recording all the economic transaction in a chronological record, one has to post these entries into the ledger accounts. Now, what is a ledger account? These accounts are pertinent to the specific title of account. Like for example, we have cash ledger, account receivable ledgers, similarly account payable ledger, and as well as the owner's equity ledger. So this ledger account is basically related with, or it is the what we can say that a classifying nature of the accounting definition, what we have studied in our initial lectures of accounting, that accounting is an art of recording, classifying, summarizing and communicating the business transactions results to the decision maker. So this is the first point, that is the art of recording. Second one is to classify the accounting transaction, that is similar nature transaction should be classified at one place, which is known as posting entries to the ledger account. So once we have done the journal in a correct fashion, the subsequent steps will be followed by taking or opting data from the previous step. If our if we have journalized our transaction correctly, the subsequent steps will give us the required or desired results. However, if we have made certain mistake in the journalizing transaction, then this mistake will leads to the subsequent steps until the counting cycle completes. So our basic agenda is to discuss the journal or to record the economic transaction in T accounts and then in a proper journal format. Then posting these entries to the ledger account. The next step will be to make a trial balance so that to know either we have posted our entries correctly or not, and if certain mistakes or omission has been done, then at the fourth step we have to make the year-end adjustment or adjusting entries. The fifth step will be to prepare the adjusted trial balance. Sixth one will be to make the financial statements what we have studied, the 3 or 4 basic financial statement like balance sheet, income statement, statement of owner equity, and as well as statement of retained earning we can make from adjusted trial balance. After making the final financial statements at the completion of accounting cycle, we have to journalize and post the closing entries. When the year will end, we have to close the nominal accounts, and after closing entries we can make final after closing trial balance. So this accounting cycle will be covered in number of subsequent lectures. However, the agenda of this lecture is to focus on only the first step, that is to journalize the economic transactions. Let us discuss what is an account and what is a ledger. By definition, accounts are individual records showing increases and decreases, and the entire group of account is kept together in an accounting record is called a ledger account. When the similar nature transaction will be accumulated in one place, that account will be known as a ledger account, or a particular asset or a liability account. For example, we have cash account as a separate ledger account. We also have accounts payable account in our books of account, which consist of the entries related with only accounts payable. Similarly, we also have the capital stock or owner's equity account that consists of the transaction pertinent to only the owner's equity section. How to use the accounts? We have a T-shaped account known as T accounts. At the top of this T, we have to mention the title of the account. Let's suppose if this T account is belonging to the cash account or cash ledger, then we have to mention the cash over it. That is, the title of account will be cash. This T account's left hand side will consist of the debit entries and right hand side will consist of the credit entries, or we can say that this T account's right hand side is the credit column and the left hand side is known as the debit column. We can also mention CR to depict or denominate the credit entries, and DR for mentioning or referring towards the debit entries. CR means credit record and DR means the debit record. Increases are recorded on one side of the T account and decreases are recorded on the other side of the account. Now it's all depend upon the title of the account. If it is cash or asset account, then its increases will be recorded on left hand side. However, if the T account is belonging or pertinent to the liability section or owner's equity, for example, accounts payable, then its right hand side will record the increases in the liabilities, and left hand side will be recorded as decreasing in the liabilities. The rules of the debit and credit will be discussed shortly in this lecture that will make you able to understand what the debit and credit entries are all about. Before understanding the debit and credit rules, let me give you a glance of the JJ's Lawn Movers Company's cash accounts in the shape of T accounts. What is a cash account and how to make it in a T shape? Here it is, a cash account belonging to the JJ Lawn Mower Company. The business entity example what we have opted in the couple of previous lecture. That example is continued in this lecture as well. There in the previous lecture we have shown the impact of certain economic transaction on the balance sheet, and those same transaction have been posted or mentioned in a T shape of account which is belonging to the cash asset. So from there we have plug in all the relevant economic transaction in this T account to make you understand how the T account looks like. The left hand side of this cash account is showing us the debit column or debit record, and the right hand side of this cash account is representing the credit column or credit record. We have taken these amounts of transactions from the previous lecture's economic transaction, and wheresoever the cash has been increased in a particular transaction, that increases have been recorded at the left hand side of this T account with the debit entry, and whenever there was a decrease in cash amount or in cash account, those have been recorded at the right hand side of this T account. So we can say that the receipts are on the debit side of this T account, and whenever we are paying out the cash amount, those are recorded on the credit side of this T account. So after plugging all the economic transaction related with the cash receipts or with the cash payments into the T account, we have a shape or a final look like this one. This 5/1 is representing the date of this economic transaction. According to the American pattern, the month is supposed to be written first, and then the date is required to be mentioned. So it is basically 1st May. This is 5th month, and 5th month is May of that particular year. And this one is representing the first day of month of May. So on 1st May, actually the company has sold the shares to Jill Jones, who have invested their money in this company. So therefore the $8,000 have been increased in the company's account, and when there is increase in the asset of the company, it is recorded as debit, and when there is decrease in the company's cash or asset, it is recorded as credit. So after plugging all the relevant receipts and payments, we have to sum up these both columns. Left hand side needs to be summed up, and as well as the right hand side needs to be summed up. After summing both the column, we have to difference the first column from the second column. The amount greater than in a particular column will be written in the same side. Like for example, this left hand side is greater than the right hand side. The difference of two columns is representing as that there is $4,125 in excess to the right hand side. So therefore we have to mention the excess amount in that specific column. This balance is the difference between the debit and credit entries in the account. How to make this account? Let me revise it once again. We have to mention the account title. Then we have to insert this T shape. Then first of all, we have to mention the reference date point, whatever the date is. And then in the front of this date, we have to mention the relevant $sign and the amount. And finally, at the time of balancing and differentiating, we have to insert another single line and then mention the differential or the resultant value in the column which is greater than the other one. And this is our final balance for cash account. Let us discuss the debit and credit rules first before delving deep into the discussion with the journalizing entries. The accounting is based on the 5 main head of accounts known as asset accounts, liabilities accounts, and owner equity accounts. Beside this, we have the revenue and expenses account as well. The debit and credit rule states that we have to follow the double entry accounting system. The debit and credit rules states that when there is increase in the assets, the increase in the assets are recorded as debit entry. And when there is decrease in the assets, as arrowhead is depicting you a sign for decrease in assets, then such account will be recorded as a credit entry. And the double entry accounting system states that all the debit entries must be equal to all the credit entries. The rule for the liability states that when there is increase in the liability of the company or in the business entity, so it is recorded as a credit entry, which in other way around I can say the inverse of the asset accounts. Similarly, when there is a decrease in the liability of the business entity, like for example, if the company has paid out its liability, such entry is recorded as a debit entry because the company has paid out its liability. So when there is a decrease in the liability, it should be or it will be or it must be recorded as a debit entry. And when the company's liability has been increased, so it will be recorded as a credit entry. Similarly, the rules for the owner's equity are the carbon copy of what we have understood in the liability section. When there is decrease in the owner equity, like the owner is withdrawing its amount of money from the business, it will be recorded as a debit entry. And when the owner is injecting its money or dollars into the business, it will be recorded as a credit entry in the books of account. So we can conclude that the rules for recording debit and credit for liabilities and owner equity are inverse of the assets rules. So normally the assets have debit balances and the liability and owner equity have the credit balances. And in the double entry accounting system, every transaction is recorded by equal dollar amounts of debit and credits. Let's discuss the two other main head of accounts known as the revenue and the expenses. So the rules for recording the revenue and expenses transactions are when there is a decrease in the revenue, it is recorded as debit entry. And when the revenue of the company has been increased, it will be recorded as credit entry. Similarly, for expenses, when there is an increase in the expenses, the rules are once again reverse or inverse to the revenue rules. When there is increase in the expenses of the company or in the business entity, it will be recorded as debit entry. And when there will be decrease in the expenses of the company, it will be recorded as a credit entry. The difference of revenue and expenses gives us the net income for the company or for the business entity. So therefore, when the revenue is greater than the total number of expenses, the resultant amount is actually the credit balance. So therefore, when there is an increase in the net income, which is supposed to be added later on in the owner equity section, if that net income has been retained out, then it will increase the owner equity or the equity portion of the company. When there is net income or positive income, it will increase and it shall be recorded as a credit entry. Rather, we can say that the owner equity will be credited with the net income. Similarly, if the expenses are greater than the revenue, in that case we got a net loss. Rather than to have net income, we have a net loss, and loss is normally a debit entry. So therefore, we will have a debit for decrease in net income, which will later on decrease our owner equity. And when there is decrease in owner equity, we have already learned that the rule state to make a debit entry in the owner's equity section. Let us see how the debit and credit rules work. Let's record some of the selected transactions for JJ's lawn care service in the accounts as we are continuing our previous example. On May 1st, Jill John and her family invested $8,000 in the JJ's lawn care service and received 800 shares of stock. So the question is, will cash increase or decrease with this JJ lawn care service? We have to analyze this economic transaction. So we have inferred that the cash level with the company has actually increased because the company has received $8,000 in exchange for 800 shares issued to the Jill John and her family. At the very same time, the second question arises, will the capital stock of the company increase or decrease? So the capital stock of the company has increased because the company has issued 800 shares of stock to Jill John and her family. As we have learned, for instance, before, that debit and credit rules for assets and liabilities and owner equity. So let's go back to counter check that when there is an increase in asset, it is recorded as a debit entry as mentioned over here, and when there is increase in the owner equity, it is recorded as a credit entry. So let's move forward to our transaction. So here it is, cash has been increased by $8,000. The arrowhead is upward and it is depicting an increase in the cash level. So therefore, we know the rule for journalizing this transaction in the T account. As we knew, left hand side is debit column and the right hand side is our credit column. We can also write DR and CR on the top of this T account. This 5/1 is representing the 1st of May. 5 is the month and first is the date, that is my first has been mentioned over here in the T account in this fashion. Since the cash level with the company has increased to $8,000, so 8,000 debited, and the rule says that every debit will have a credit as well. The next account title which has been affected with this transaction is the capital stock, which is the owner equity actually. And when there is an increase in the owner equity, it is recorded as a credit entry. So therefore, we have mentioned the same $8,000 in the credit column of this T account. This is the way how we can journalize our economic transaction in T accounts. Let us discuss the my second entry as this example continues. My second, the JJ's purchase a riding lawnmower for 2,500 cash. So our question is, will the cash increase or decrease? As we knew that the JJ has purchased a lawnmower, so therefore the cash level will decrease. And will tools and equipment increase or decrease? So definitely the transaction is saying that the company has purchased the lawnmower, so therefore tools and equipment will increase. So one asset has been increased and the other asset has been decreased. So what impact this transaction will have on our T accounts? As we can see that when there is decrease in cash, it has been recorded as credit. So therefore $2,500 is mentioned in the credit column. The second asset account has been generated with the title of tools and equipment. And as we know that the tools and equipment has been increased, so when there is increase in any asset, it is recorded as debit entry. So same has been done in this T account. Let us discuss my 8 transactions when JJ has purchased a truck of $15,000. So the question says, will truck increase or decrease? So definitely the truck has increased, which is tools and equipment. JJ paid $2,000 in cash. So will cash increase or decrease? Definitely it will decrease because the company has paid $2,000 in down payment and issued a note payable for the remaining $13,000. So the company will generate a liability and the company's liability will increase with $13,000. Truck is an asset. When there is increase in asset, it will be recorded as debit entry. Cash is an asset, and when there is decrease in cash, it is recorded as credit. Notes payable is a liability. The rule states that when there is increase in liability, it is recorded as credit. Asset is recorded as debit, and this asset will be recorded as debit entry. So let's see how do we do that. Here it is. We have mentioned another account title in the T shape with name of truck. Truck is an asset. So truck increase in 15,000 with a debit balance. Therefore, we have mentioned its entry in the debit column of this T account. At the same time, we have a cash account already established. And here we have to mention the 8th of my transaction in the credit column because the company has paid out $2,000 in the payment of purchase of this truck as down payment. Next, we have to generate the liability account name with notes payable. And as we know that when there is increase in the liability, as the rules state on slide number, let me show you once again. On the slide number 8, we have the liability rules. Liability rule states that when there is increase in the liability, it will be recorded as a credit entry. Therefore, we have mentioned the owner's liability account, the notes payable liability account with a credit balance of $13,000. Let us discuss the May 11 transaction, and it states that the JJs purchased some repair parts for $300 on open account. So we have to analyze the transaction carefully. Will the tools and equipment increase or decrease? Definitely, the company has purchased repair parts, so therefore the tools and equipment will increase in the company. And as we knew that they have purchased tools and equipment on open account and did not pay any dollar against this purchase. The question is, will the account payable increase or decrease? After analyzing this transaction, we conclude that another liability named as accounts payable will also increase. Now we have to analyze this transaction further, that tools and equipment is our asset and account payable is our liability. So we have to generate the relevant accounts for these. Here it is, the tools and equipment has been increased with $300. So therefore it will have a debit entry under the title of tools and equipment. We have to mention the date 5th 11th of May with $300 needs to be mentioned over here in the debit column. And subsequently, as we knew that the rules state that every debit entry will have a similar amount of credit entry in the journal or in the T accounts. Therefore, we will mention or make another account with the title of accounts payable. The reference point is 11th of May, and as there is an increase in the liability, therefore it is recorded as a credit entry. So dear student, this is the way that some of the transaction can be journalized in T accounts by following the double entry accounting system. On May 18th, some of the part has been sold out by this JJ Lawn Mower company to another company named as ABC Lawn Mower at a price of $150, which is equal to its cost. So will the tools and equipment increase or decrease? So definitely when they are selling out, it will decrease. And will the account receivable increase or decrease? As the other company named as ABC Lawn Mower is not going to pay us the amount at the moment, rather the company is going to pay out within 30 days. So therefore, account receivable will increase. So when there is increase in the account receivable, it will be recorded as a debit entry. And when there is a decrease in tools and equipment, it will be recorded as a credit entry. Now let's move towards, after analyzing these transactions, let's move towards a formal method of recording these transactions in the chronological order in the journal format. Here it is, the journal. It is the first step of journalizing the economic transactions. And it states that in an actual accounting system, the transactions are initially recorded in the journal. And journal means a record of daily, day-to-day routine activities. So this is the way we have to mention the journal. Then it has basically four main columns. Left one is the date column. The center one is known as the account titles with certain explanation. Dear student, we have to mention only single line to bifurcate this account title and explanation from the debit column. And then the rightmost column will be our credit column. Let's move towards the first transaction and then analyze it over here, that how to record these transactions in the journal format. Here it is, our first transaction, and it states that on May 1st, Jill John and her family invested $8,000 in the JJ Lawn Care Service and received 800 shares of stock. So we got the cash account debited with $8,000 and the capital account was credited with $8,000. Now the same transaction will be posted in a formal method of journalizing these transactions. So this is the way we have to mention the month, like my first. Then we have to record the debit transaction first. The cash was debited with $8,000. And then we have to slightly indent the credit entry, and the credit title or accounts title was capital stock. It is slightly indented in order to bifurcate or differentiate the transaction from the debit title. Capital stock was credited in the my first transaction. And then we have to mention a slight narration just beneath these two titles, that owners invested cash in the business. So this is the way how we are going to analyze the transaction and then to record in the accounting cycle's first step named as journal. Thank you very much for listening to this lecture. If you have any question, feel free to ask on KCMS, or another way around, you can also email me on my official email address as mentioned in the footer of this lecture. Good luck for the day. Allah Hafiz.